Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their career, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors. Thank you so much for listening to today's episode. And if you are traveling to Vegas for Vision Expo or are already there, hopefully you have safe travels. If you're going to be there, hey, reach out. We'd love to get a chance to meet with you, connect with you there. And on today's episode, I continue the life insurance theme, and I welcome to the podcast Broc Buckles, co-founder of BC-Brokerage, an insurance brokerage, and we dive into permanent life insurance, and we talk about the different types of permanent life insurance, the appropriate uses of permanent type life insurance. We talk about the ways you can adjust the policies or get out of the policies if needed. So we dive into this topic so that hopefully you as an optometrist can make better educated decisions on what can be a pretty complicated financial tool and insurance product. You can check out all of Broc's information in our show notes, which you can find at the Education Hub on my website, www.optometrywealth.com. And while you're there, feel free to schedule a no-commitment introductory call. We can talk about whatever's on your mind financially, and we can talk about how I serve optometrists all over the country navigating decisions around insurance and so much more. And with that, without further ado, here is my conversation with Broc Buckles. And welcome back to the Optometry Money Podcast. I am your host, Evon Mendrin. I'm excited to have a conversation today about a topic that's not always the most exciting, but I think is important to at least understand, and that's continuing this life insurance theme. And today will be about permanent type cash value life insurance policies. And if you listen to last week's episode, you kind of got an introduction to how these different types of policies work. Well, today I want to drive in a little bit more specifically on these type of policies. And I want to talk about how these type of policies work, what you should expect if you hold one of these policies, what are some of the best use cases for these type of life insurance policies, and then how to make adjustments. If you're someone that wants to keep it long-term or even wants to remove that policy from your life or whatever it is, how can you make adjustments to these policies? So to help me through this, what should be a riveting conversation about life insurance, I've got an awesome guest here, Broc Buckles, who's the co-founder of BC-Brokerage. Broc, thank you so much for coming on.
Evon, it's great to be here, man. Glad to get to spend some time with you. And like you said, talk about the riveting subject of life insurance, which I think the first thing you have to acknowledge, man, is that it's not the most exciting thing to talk about, but it is something that's useful to have knowledge around. So I hope people can get something from this.
Yeah, I definitely agree. And I think it's useful to have a conversation, and at least helpful to have a conversation around these types of policies, because for optometrists listening, relatively high earners, often business owners, you're often going to be, I would say, targets for these type of policies, at least for those that are selling them. And there are very strong opinions about what to do with these policies on all sides. Opinions about you should never touch them. They are the worst thing ever, to the complete opposite, which is these policies solve all financial and world issues and should be used for all things. And so I think it's helpful to just sort of pull all of that fluff and opinion away and just let's talk about how they work, what they're actually useful for, because I would assume you agree, Broc, like these are just tools. These are insurance policies, and all tools have some sort of use. They may be used wrong oftentimes, but they have uses. And so I think it's helpful just to talk about them and get some accurate information about them and to see how they work, so that optometrists, for you that are listening, so you can at least make an educated decision when faced with it. So before we dive into all that fun stuff, just talk to us a little bit about your background. What's the work that you're doing? Tell us a little bit about your business.
Yeah, definitely. So started out, so people know how I've kind of been on the both sides of this industry, if you will, right? I started my career at a big Fortune 500 company, Northwestern Mutual. A lot of permanent life insurance sales. That's kind of what they believe in over there. they really, really like it. And then I came to become a little bit, disgusted, I'd say, of the industry and people selling things and things that didn't necessarily make sense for people's financial plans, right? You had a lot of people that had just graduated college, went through a couple-week training course, and were out there toting the benefits of permanent life insurance and how great it was for every situation. And so I got a little tired of it. I was there for several years, and then ended up leaving and talked to the co-founder of BC-Brokerage, who is Peter Travalo, about what might be another great opportunity in the insurance industry. And so we started BC-Brokerage. We work exclusively with the fee-only financial planning community all over the United States, and implement solutions when they're actually necessary. We're not trying to sell people anything that they don't need. We really believe in solutions and planning before actually product. So That's kind of a synopsis.
Yeah, you and I have probably our origins in our professional life here are probably pretty similar. I started out my earliest couple years in a similar company, probably saw a lot of the same things that you did, came to a lot of the same conclusions. And so even though I don't sell the insurance anymore, and you and I have seen a lot of those same things. So let's dive in here then, and let's talk about permanent type cash value life insurance policies. Talk to us about how those policies work. And I ask that understanding that this is a really broad question because there's different type of policies. There are whole life policies, there are universal life policies. And even within those two general categories, there's different types and flavors of how those policies work, all with their own details and nuances. So sure. I'm maybe putting you in sort of an unfair position here, but just sort of generally, how do these policies work?
Yeah, no, we can conceptualize, right? We don't have to get into all the details to kind of talk about how they work on a baseline level. So with a permanent policy, the big thing is it's supposed to be for life, right? It's a permanent policy because it's permanent. It's supposed to be forever. And essentially what you're getting is a death benefit, just the same way that you would with a term insurance policy, except for a term insurance policy expires down the road, right? So on a basic level, it's supposed to be insurance and advertised as insurance, but with the permanent policies, what a lot of people tote and like to talk about and kind of harp on in terms of the benefits is what we call the cash value, right? So that's basically a section of the policy or a bucket within the policy that can accumulate money over time, along with the death benefit oftentimes increasing over time within these policies. But the big difference is that the bucket of money kind of grows over time and is supposed to essentially gain some interest most time in a traditional whole life policy. That's through the use of dividends. So based on how the company performs, they will credit these policies with dividends, which will help it grow beyond the principal amount if you're with a reasonably good carrier over the life of the contract. So there's essentially, a bucket of money that kind of grows within the policy, if you will.
Got it. So you've got the life insurance part of it, which is the protection from you passing away, essentially financially. And then within that policy is this bucket of cash value. And from the life insurance company standpoint, what is the purpose of that cash value? What does it do for the policy?
Yeah, so what it does for the policy is basically gives you access to a set of funds or a bucket of money that you can access throughout the course of your life, right? With a lot of them. And then you can have, what they'll try to say is you can have basically a non-correlated asset if it's just a plain vanilla traditional whole life policy that you can use to borrow money from in down markets and use for different types of things like that.
Got it. And you mentioned you can get some sort of interest or addition or growth on that cash value, depending really on the type of policy it is. You mentioned whole life and dividends are sort of, I guess, essentially a tax-free return of premium. Is that essentially a way to think about what dividends would be?
Yeah, kind of. I mean, it depends on, like you said, the way that the company's structured and how it performs. Essentially what's happening is you're paying these dollars for this whole life policy. Obviously, what they're doing is not just having it sit there. They're going out and saying, hey, we're a huge company. We've got potentially billions and billions of dollars of capital. So we're going to invest in these different, real estate deals or, different things that are going to make the company's overall portfolio grow, right? And based on how the company performs and how their investments and what they do with the money, how all of that performs, they will then decide what they can credit back to the policy owners' policies. And then that would be what the dividend rate would be in the amount that you're going to see kind of go back into that cash value oftentimes.
Got it.
And you can take it, to be clear, you can take it as an addition, which actually means it goes back into the policy and kind of reinvests in that cash value and makes it grow over time. Or you can actually take a cash dividend, or you can have it applied to the future premiums, right? So there's different things that you can do with the dividends. Most of the time, the way that they're structured when people are looking at illustrations is with it going back into the policy, because that obviously makes it look a lot more attractive over time.
Got it. And so that's whole life, and universal life policies are that other type with very different type of insurance companies. And they work differently on how that policy is credited interest or grows. Can you talk to us just generally about how that might look?
Yeah, definitely. So on a universal life policy, or what you're commonly seeing right now is indexed universal life policies. Essentially what it is it's going to ride on the S&P 500. Typically, you're going to see it ride on some sort of index, right? So some of that money that you're paying for the insurance policy will obviously go to pay for the insurance itself, right, in case something were to happen. But it's kind of like a term insurance policy within a larger policy. So a lot of times those premiums will go up over time, and you'll have to actually increase the amount of money that you're contributing to it to make sure the policy doesn't lapse. But on a basic level, some of that money that you're putting in there is going into the cash value, which is then tied to some sort of index. And with an index universal life policy, a lot of people like to use the, I guess, kind of analogy of bowling with bumpers, right? So you can't lose money from the cash value necessarily, but there might be a maximum of what you can have credited back to the policy. So say that the market has a down year, right? And you're watching your 401k and everything go down, right? Which is never fun, but you're not going to lose money out of your index universal life policy. It kind of has a backstop, if you will. But on the counter side of that, when the market does really well, say the market does 20%, there might be a maximum of your policy being, 12% that can be credited towards it. So where does the insurance company make money on that? Obviously, it's them taking that additional 8%, which is coming back, and they're going to rake that back into them. So, there's less downside sometimes, but you don't have as much upside.
My next podcast episode, next week's episode, will be actually entirely about the myth versus facts of indexed universal life policies. So we'll save a deep dive on that specifically for next week. And even within universal life, there are even other types of policies outside of that. There are just sort of traditional fixed type universal life policies where it's more about a fixed crediting rate. There's what was the hot item when I was in the insurance world, the variable universal life. That was sort of the hot item at the time, at least for the company I was with. And that is where the cash value can actually be invested, actually invested in sort of mutual fund-like accounts inside of the policy. But so there's all these different flavors. Ultimately, it's insurance primarily insurance with this cash value component to it that grows in different ways. And talk to us about how someone can access that cash value. How do we actually get our hands on the cash value in there?
Yeah, so there's a few ways that you can do it. One, you can cancel the policy or access it, right? Just flat out cancel the policy. The issue with doing that is the whole structure of these most of the times is touting the tax benefits. And so anything, if you do decide to do that, anything beyond the principal, meaning the money that you actually put in, is going to come to you and it's going to be taxable, right? So most of the time what you will hear people say that you should do is take an actual loan from the cash value of the policy, right? So you are taking a loan, you are borrowing it. Depending on the loan provision, usually 5 to 8% is what it's going to cost you to access that. A lot of people will try to tell you that you're paying yourself back. You're kind of structuring it in different ways, but the most common way that you're going to see people access that cash value is through a policy loan. And that's where you start to hear people touting the benefits of, it's great. It's like a Roth IRA on steroids. Like, not exactly. There are definitely catches to that. You can't just call an insurance product a Roth IRA or even technically an investment, right? So there's a lot of people out there not doing it the right way, but on a simplistic level, most of the time you're going to access it via a loan.
Got it. So you can do, I guess, what they would call partial surrenders. You can take out parts of your cash value out up to the amount that you put into it. I guess it's like your basis. I guess if you had a stock portfolio, mutual fund portfolio, there's a cost basis in your portfolio where if you sold your shares, that basis would not be taxed. And this is sort of a similar concept in that you can withdraw, generally speaking, right? Very generally speaking, you can withdraw up to your own basis, which are just your own premium dollars back without being taxed on those dollars because you're just getting your own after-tax dollars back. Once you exceed that, once you get to the value above that, then you're starting to get into what are actually going to be taxable dollars. And so, Broc, what you're saying is that at that point, someone's usually going to be looking at borrowing against the cash value from the life insurance policy, which comes with interest within that policy. That's important to understand, and that when people talk about tax-free income within these policies, you're not actually generating tax-free income. You're either, number one, pulling out your own dollars or borrowing against these policies. And in general, debt is not considered income, or at least taxable income. You can borrow against your house. You can borrow against a taxable investment account. So you're borrowing against the cash values policies. Can you do that into infinity? Do you have to pay that back? Are there consequences to borrowing too much? Like what are some of the dangers that can be looked at when borrowing from these policies?
Well, the biggest and most obvious danger is that if you borrow too much and then you borrow beyond, really what you could, and then the policy doesn't have cash value, or you've borrowed from it and then you've let the premiums also come out of the cash value, or that's how you're trying to pay it. And then all of a sudden you had this strategy where it was going to be tax efficient, and then oops, the policy lapses, right? Well, guess what you owe now? You owe tax on all of those dollars.
You're going to get a 1099. Yep.
That's right. And so that is never going to be a fun thing or a fun fact to have to face. So it is important to acknowledge that if that is going to be your strategy, you are going to have to keep that policy in force. So that is the biggest and most obvious, I would say, overlying to borrowing from these policies for sure, Evon.
Got it. And if an optometrist owns one and they're paying premiums into it, what are some of the expenses within the policy that they're expecting as they're paying these premium dollars?
Yeah. So one of the things you got to know is that there are fees within a policy that are associated just within owning the policy, the administrative costs of the policy. People have their eyes on that policy, and it does take manpower to be able to manage all of these policies that the insurance company is managing. The other thing is, and a lot of times they're going to try to sell, or someone's going to try to sell someone a policy based on the fact that, well, look at how much money you're going to have going into this cash value. And they almost show it or talk about it in a way to where every premium dollar that you're paying is actually going to go straight into the cash value. Right. But and so you're thinking to yourself, oh, that's phenomenal. If I'm putting $100 in there every month, right? $1,200 is just going into this thing that I'm going to be able to access down the road. So $1,200 a year, or $2,400, or however much, could be $15,000 a year. But no, right? That's not the case. There is a cost of insurance within the policy. Yeah. And so what a lot of people don't understand is, even with the better companies, the better whole life companies, right, that have better dividends, more competitive products, the flipping point to where you're actually going to see more money in the cash value than what you've contributed is oftentimes somewhere, depending on the company, between years 8 and years 15. I just looked at a policy the other day. It's not even net positive in terms of them having anything beyond what they put into it until 15 years down the road, right? So if you're not working with one of the better companies, unfortunately, we see close to 70% of people not holding on to these things long term. Yeah. Right. And the vast majority of times, 90% of the people that sold it to you aren't even going to be in the business to try to help you service it. Right. Because 90% of the people that start in the insurance industry leave the insurance industry. So now you're up the creek without a paddle, no one to help you navigate this thing that was promised as kind of an end all be all.
Right. And tell us about one of the things I didn't ask about, but there's in the earlier years, part of that is the cost of that, but there's also surrender charges to where if there's often touted that you have liquidity within this policy. If you have one, you can do whatever you want with that cash value. That's not really the case. Talk to us about what surrender charges are and why that's important.
Yeah. So with certain types of policies, namely universal life policies, there are things that are called surrender charges. And so it depends on the company, but a lot of times if you cancel within the first 5 to 10 years, you actually have to pay to get out of the policy or take a hit on the cash value to get out of the policy. And it's funny how people forget oftentimes to talk about the surrender charges when they're asking you to buy the policy. But yeah, essentially, it's and it goes down. It's kind of usually on a schedule to where it will go down over time. So if you want to cancel after the first year, it could be $5,000 to cancel the policy. Second year, $4,500, all the way up to year 10. If you want to cancel, maybe it's $1,000, right? Yeah. But it is important to know that there are catches to everything, right? And it as much as it's touted as something that's fantastic and is going to be a great part of your portfolio and you can take out of it in down markets. If for whatever reason you say, hey, this is great, but I don't know if this is actually for me, or I have a new financial advisor, or I was working with somebody from a big insurance kind of brokerage type deal or a captive company, and now I'm working with a fee-only advisor. And they have a different philosophy about money, and the way that they're explaining things to me makes a lot of sense. But unfortunately, you just bought that policy 5 years ago. There's a good chance that you might have to bite the bullet a little bit and pay to get out of it.
Yeah, and I guess if you look at if you ask for an in-force illustration, or if you get a policy statement, you'll see the cash value of the policy and then also a surrender value. And if those are equal numbers, then you've sort of gotten out of that surrender range. But you might be surprised if you're buying it for the immediate liquidity of the cash value, only to find that, well, not necessarily. That's just the sort of the reality of how these policies work, and it's understandable. There are costs to run it, including potential commissions paid to the agent, so that the insurance company has to recoup some of those costs for you owning the policy and having it sold and marketed. So that makes sense as long as someone is aware of why they're purchasing it. And let's just talk about potential uses for these policies. Like, we can talk all day about the potential misuses and incorrect marketing and ways that goes, but what are the actual best use cases for a permanent type policy? When would someone want to proactively go for that?
Yeah, that's a great question. And there are absolutely cases, right, where you want to use it. So just like you said, this is a tool, right? And for somebody that only has a hammer, everything looks like a nail. So for the people out here touting this as it's the greatest thing since sliced bread, watch out for hyperbolic statements. Stay away from hyperbole. If someone tells you it's the end all be all, it's not. There are other ways to do things. So moving on to the good parts, or the good things that you can use it for. There's a few that really come to mind, right? The first one is obviously estate planning. Right? High net worth individuals who, one of the best ways realistically to mitigate estate tax and have that offset so that it can be effectively passed on to future generations. You can put it in trusts. There are different ways to use it for estate planning, and permanent insurance is a great way to do that, right? We don't know, and we can't bet on necessarily when someone's going to pass away. And so term insurance a lot of times just is not super effective for mitigating estate and tax planning, right?
Yep.
The second thing would be special needs planning, right? So a lot of people have someone in their family that has special needs, and they are caretakers for that individual. And if they were to pass away, and obviously if that person with special needs is still living, then there's going to need to be care. And if that's what has been happening for that person's entire life, a lot of people want to make sure that they can still help take care of that even if they're not here anymore, right? And so, permanent life insurance can be great for something like a special needs trust, and setting that up and having an injection of cash in the event that the predominant caretakers, oftentimes parents, are no longer here. Another one would be long-term care. Right. So historically, the long-term care market has been shifty, to say the least. And what we've seen is that there are carriers that are building long-term care products on permanent life insurance chassis. Right. So with traditional policies, number one, it was a use it or lose it. With the hybrid asset-based policies built on a permanent life insurance chassis, even if you were to pass away suddenly, there's a death benefit there. A lot of the traditional policies were reimbursement policies. With the new hybrid asset-based policies, the premiums can never increase. So with the old policies, they could send you a letter saying, hey, your premiums went up by 30%. They can't increase legally with the new policies. And then it's on an indemnity chassis. So instead of the old policies where it was reimbursement, basically as soon as you qualify for 2 out of the 6 activities of daily living, which is, being able to go to the bathroom, eating, stuff like that, they just start stroking you a check. So there's a lot of benefits now for using it as long-term care. And then the final one would be, if you've completely run out of tax efficient options and ways to put away money, I'm not saying that you can't use it as kind of a vehicle for some tax efficiency if it's going to be better than just throwing money somewhere given your tax bracket, right? It's just that obviously is not a solution for everyone.
Yeah. And it sounds like, so to sort of summarize, estate planning needs and talking about estate taxes. I mean, right now you're needing an estate's worth well over 10 million to likely be looking at estate taxes. That it's set to change back a little bit after 2025, but you need a substantial net worth in order to start to look at that. It's been a lot lower in the past. So yeah, perhaps that's something we'll need to think about in the future. But at this moment, I don't know that a lot of optometrists are going to be thinking about that. But special needs is a great point there in terms of just a very specific case. And it really, think again about these policies are risk management tools. It's insurance. And so you have a permanent risk to cover. You need coverage over your lifetime. And special needs is a perfect example of that. You might also say if someone is just dead certain they want to, talking about life insurance, that's not the right word to use, it is very certain that they want to leave a legacy in some way for a very specific purpose. And, you can compare just simply investing the premiums versus buying a permanent type policy. But if you have a set goal for a set legacy and you want absolute outcomes, then perhaps a permanent policy makes sense there too. Again, you're matching the need with the type of product here. And like you said, long-term care is interesting because there are some states right now. Well, Washington is one that had already enacted a long-term care tax to provide a statewide benefit. They had an opt-out period that, from what I understand, was crazy. And definitely California, crazy, where I'm at right now, is considering the same thing. We don't know yet whether there's going to be an opt-out period. We might not find out until it's too late. Other states are as well. So this long-term care discussion, I think, is interesting when you're looking at your different options. That might be somewhere where you want to evaluate that as well. And then, yes, there is a use for it when you're building up some cash value for other purposes, those ancillary benefits. Tax deferral, again, when you've ran out of other options, I would say, and you have no need for liquidity, you've got plenty of liquidity in cash, and also potentially a taxable investment account, and you really still need to defer a high amount of cash, then perhaps it makes sense. There's some academic type work that's sponsored by life insurance companies that can talk about the uses of these policies in a retirement withdrawal scenario. So maybe there's uses for those. I don't want to exclude it altogether. I would never say that they are the primary or all use for that. So risk management first, potentially looking at these secondary benefits next. Let's talk about making adjustments, something you had touched on earlier in that. And I want to think about this from two scenarios here. Number one is that someone purchased the policy for an intentional goal, like we've talked about, and they're expecting to keep it long-term to fulfill that goal. What are expectations that they should keep in mind in terms of how that policy might change and how they might need to adjust the policy in order to keep it in force for that goal?
Yeah. It's a great question. So depending on the type of policy, right, one of the things that it's important to, foresee is that the initial illustration that someone shows you, right, when you're buying this policy, you're going to see that there's two sections. There's a guaranteed section and then there's a non-guaranteed section. And oftentimes people want to talk about the non-guaranteed section because that's the one that grows a lot more attractively.
Right. It's the more exciting part of that ledger. Yeah.
Right. Based on, what they've historically seen. And they, some of them do 20-year averages, 30-year averages that kind of project it going out. So understanding that your policy may not perform exactly the way that non-guaranteed column is showing. I always like to make that known. Like there are companies that have been great forever and then start not doing so well. And that could be everything based on poor upper level C-suite management, right? People just making different decisions. So that would be one of them. The other thing to kind of keep in mind is starting with the end in mind, right? So to make sure that when you're making the initial decisions, it's something that you can absolutely commit to and that you're going to feel good about, right? In terms of a dollar amount, because that's one of the biggest things that we kind of see happen is people kind of get into it and then they realize down the road it's not, they cannot continue to fund it, or life changes, they don't need it in the same way. So starting with the end in mind and actually having a solidified plan and understanding what you eventually want to do with the policy is extremely important. But most of all, I think it's important to emphasize that there are absolutely changes that you can make to the contract down the road. So if you didn't make the perfect decision from the get-go, or you're not funding it with the perfect amount, or maybe it's too much, you can absolutely make changes.
Got it. So that's a good point. Start with the end in mind, in that and this is true for all financial products. What is the goal for what you're trying to solve for? And then match the product towards that. Don't start with this product and say, well, let's stretch this product to do whatever I want it to do. Let's start with the end goal and say, what is the best fit for that particular goal? And so let's assume, and that's also a great point about these sort of like illustration games where you can almost illustrate, I guess, within what's law right now, although I'm sure from what I understand, it's still pretty broad, but you can illustrate a lot of different things. And if you were only looking at the projected illustrations and not taking into account the guaranteed side of it, what's contractually guaranteed in that contract, a lot can change over your lifetime. That can differ from what those policies illustrate. I remember back in the day when we were talking about, or especially the wholesalers were talking about the variable universal life. I mean, we were looking at illustrations where it's just a straight line 8% return throughout the entire, like not even thinking about how it might actually be invested in the cash value, but just a straight line 8% return. And wow, look at what you can pull out of this policy 40 years from now. It's thinking back, like it's nonsense. I mean, it really is nonsense. And you have to be aware of these illustration games that you can see when you're looking at that. So keep in mind, things can change from what you see there. And assuming things change, assuming you have that goal and you're planning to keep it long term, let's say the policy doesn't perform as well, and a lot of times for reasons outside of your control. It sounds like, number one, you as the policy owner need to behave as illustrated. Meaning that if you're illustrating out a certain amount of premiums each year, like you need, in order for you to get close to what's illustrated, you at least need to be doing those premiums each and every year, right? It sounds like at a minimum, to get close to that, you need to be doing your part. But secondly, let's say the cash value doesn't go as planned. What should they expect to do to keep that policy in force? Is it increasing premiums in order to fund it a little bit more? Is it lowering death benefit? What are some of those adjustments?
Yeah, so it completely depends. There's a few things that you can do with a permanent life insurance policy, right? So if the cash value is not performing the way that you wanted it to, you can obviously just get out of the policy. Say, I don't want this policy anymore, especially if it's a whole life policy, or maybe it's even a universal life policy. You can obviously get out of the policy, right? That would be step number one, if you just don't see it going anywhere. The second thing would be, you can continue to fund the policy at the rate that you're going and see if the performance changes down the road. But once you've already had the policy for 20 or 30 years, maybe you bought this policy when you were, just getting out of school and you funded it, there are a few options that you can do. One, you could say, okay, I don't really see this as a wealth building strategy, but I do like what I can do with it in terms of the life insurance aspect, right? Mm-hmm. So you could do what's called a reduced paid up option, right? On a permanent life insurance contract that would allow you to say, hey, I'll take a little bit less death benefit, but I don't want to put any more premiums into this thing. So kind of like freeze it, right? Say the initial death benefit was $250,000 or $500,000. And they say, hey, if you want to take it reduced paid up right now, we'll give you a $250,000 death benefit. You never have to touch it again. You can use it for legacy planning or a way to pass on wealth down the road. Right. So a lot of people will do that if they kind of don't see the cash value doing what they want it to do, or the wealth building strategy hasn't been exactly what it was touted at. A lot of times things are just over illustrated and then underperform. So that would be one of the things that you could do. And the other thing would be to actually 1035 exchange, which is a way of basically saying move the cash value and money in this policy to another policy that makes more sense for what your current goals actually are. So a good example would be, say that your policy right now doesn't really have a long-term care feature that you could use that for specifically. You could take an older policy that you've been paying into that maybe has a substantial amount of money, put that into a policy that's more focused on long-term care and use it for something that is a little bit more relevant to what your lifestyle calls for today.
Got it. So that's sort of like in the real estate world, that would be like the 1031 exchange, where you can exchange the equity in one property into another like kind investment property, continue to defer the capital gains because you're into the next property and continue that on. So this is sort of a similar tax concept in that you can take that cash value, 1035 it, transfer it into another insurance contract, or even I believe an annuity. Is that right?
Yep, you can.
Into another insurance contract that has a better use for whatever you're planning to use that for, without having to just close the contract altogether and pay taxes on, the growth above your premium. So that's one way to do that. And I guess if you're someone who realizes it, like you mentioned, it's not what you thought it was, and you don't intend to keep the policy long term. Maybe your buddy from high school had sold it to you, or your brother-in-law, whatever it may be, and you're looking around and saying, well, wait a minute, this doesn't actually make sense for me long term. You can use some of those same options that you talked about, right? You can surrender the policy and just close it down altogether. I guess some things to think about in that case are going to be whether there's a surrender charge, like you mentioned earlier, whether you're actually able to get your cash value or not. Is there going to be tax on that surrender? And just comparing those things to whether it's worth it. Like, is it worth it just to move your premiums to some other solution? You do have to consider that. It's not always the best scenario just to close the policy down altogether and take the cash value. You have to consider those other things. But it sounds like you've got those other options too. You can use some sort of reduced paid up amount there. Can you also just simply lower the death benefit, like in a universal life policy? Can you just lower the death benefit for a reduced premium? Can you stop premiums altogether? Like how would that work?
Yeah, that would be the other one. I appreciate you bringing that up. So with a lot of contracts, permanent, universal life, several contracts, carriers will actually allow you to just reduce the benefit amount. And so, like you said, instead of moving into another product or, 1035 exchanging it or getting rid of it totally, you could call them up and essentially say, hey, this doesn't really make a lot of sense for me at this amount, but I think I could justify it at a lower price or a lower death benefit. And that's going to be more doable for me. I'm going to feel a little bit more fiscally responsible by paying this amount instead of the one that I'm currently paying. So yeah, you can definitely decrease it as well.
Got it. So you can sort of salvage the situation by adjusting the policy in some way, or waiting until you're out of surrender and just surrendering that down and trying to make the best use of your premiums in that case as you possibly can there. And, sometimes you just have to sort of admit that you made the decision you did with the information you thought was best, and then what's the best path forward moving forward. And I guess sometimes we can kind of feel like there's a sunk cost there and you have to keep going because you started it, but you can adjust. You can adjust the way you're using your dollars and adjust how you use these policies, or 1035 it to a better use of an insurance contract. That's awesome. Really helpful there, Broc. Anything else that optometrists should know about these policies? And we've talked about different ways that they are pitched and sold. Just be aware, ODs, of when you hear, I don't know how to, exaggerated claims about these products and how they do everything. No product does everything well. They may do a lot of things, and they may do a lot of those things not very well. So just watch out for exaggerated claims. Watch out for fluffy names that don't actually say life insurance. It's funny how that comes. There's all sorts of names for these great, wonderful products. Like I won't even go down the list, but a lot of times they won't even mention the word life insurance. Interesting.
Roth IRAs on steroids.
Roth IRAs for the rich. Compounding golden accounts.
Goose egg. I heard golden goose egg one time. I was like, that cannot be real. It's like, it's real.
So, there's all sorts of stuff out there.
you have to watch out for the hyperbolic statements. If it's being touted as something that's the end all be all, if it feels like a snake oil sale, right? Get out of there. The other thing is debt elimination platforms. Okay. Like, I'm just going to be straight up. A life insurance policy is not a debt elimination platform. A lot of people will say, use this as a way to pay off other debts that you have. So have this policy, pay into it when the cash value gets to be enough, borrow from the cash value and pay off your debt, pay off your credit card debt, pay all this, which and the way that they're going to justify it is by saying, well, this cash value is going to get this dividend, which is kind of like interest. So you're really using a bucket of money that's getting interest to pay off your other debts. So you're getting help and additional money to pay off your debt. Well, yeah, it's also tied to you having a $500, $1,000 a month life insurance payment, and the insurance agent's going to make a lot of money off of that. So if it feels funny or it feels like they don't know what they're talking about, or they're calling it things that it's not, get out of there.
Well said, well said. And what's sort of crazy about that is that you not only have to add a premium into your cash flow, so you're adding another cost, and you eventually have to borrow from the policy in order to make it work. So you're just replacing one set of debts with another, and it's different debt. I mean, it has different characteristics. It's potentially you may not have to pay it back until the death benefit comes through. Like, so it's different, but you're still taking on debt in order to pay down other debt. So be mindful of that. I think that's really well said. I really appreciate your time. I think this is just a helpful overview of can be a complicated product. And there's, we're talking generally today, there's a lot more we could have gone into, and they all, again, these different policies, whole life, universal lives, they all have their different nuances and details. So really, if you're evaluating this, work with a financial advisor or a third party that potentially doesn't sell these products, or at a minimum, work with a broker like Broc here that can work with different carriers and go through the contract with you and go through that illustration with you and talk to you about how the reality of how it may or may not work as illustrated. So you want to make that decision as educated as possible, and always starting with that end goal. What is the reason you're needing to purchase something, and is this product going to fulfill that need? So Broc, really appreciate that. Where can people find you and follow you and learn more about what you're doing?
Yeah, so Broc Buckles on LinkedIn, it's BROC, there's no K. And then I think it's Broc_Buckles on Twitter. I try to put out a lot of information and posts that educate, consumers and financial planners alike of, the actual reality of the insurance world. So, and then Broc at BC-Brokerage. If you guys have any questions specifically, or, would just like to get a policy looked at or checked out and make sure that, it's something decent, let us know. We're always happy to help.
Appreciate it. Well, we will catch you on the next episode of the Optometry Money Podcast. Stay tuned. Next week, we continue this riveting theme of life insurance, and we'll talk about sort of a deeper dive into the myths and legends versus fact of the specifically indexed universal life policies. So stay tuned. We'll catch you there. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.